Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk technology here. There's a lot happening. Again, the Bloomberg News story today, which is just amazing to me. Nvidia, Microsoft, and Apple are bigger than the China stock market.
Wow.
I don't know who did that math, but that's like a good math that makes a good story to me.
That's a great story. I mean, does it mean they're overvalued or China's undervalued?
All right, let me check in with somebody who might have an opinion here. Anurag Rana, Bloomberg Intelligence, senior tech analyst. Anurag, I mean, ever since I've known you, we're going 14 years, you've had like the easiest job on Wall Street. All you got to do is say tech spending's going up, buy these things. That's good for technology. Step back today. You walk into a portfolio manager's office here, and the portfolio manager, he or she has been in industrials their entire career. Now they're told they need to get some tech exposure. Where do you send them?
Yeah, so this is, you just made a comment that, 18 months ago or so when you heard of AI, you said go buy Nvidia. And that's, that has worked out very well. But now the question is, for the next leg of AI beneficiaries, do you go downstream or you still stick to the hardware players? And that's a very tough question, frankly. But there are enough players in the software area, in the services area that have not seen the benefit of AI. And I think those are the companies that are going to see sales improve over the next, let's say a couple of years, because the downstream effect of all the increased spending has to reach them. It's just a matter of time. The difficult part is to put a real pulse on when that's going to happen.
Yeah, let me throw in a fly into the ointment. Can the Justice Department screw all this up at some point?
Yeah, they will try very hard, and I think these companies are also getting smarter and smarter. But frankly speaking, I think what we saw after the financial crisis was banks did become much bigger. And I think, unfortunately, for the Justice Department and other regulators, I think the large tech companies will become much bigger because of AI, just because they have the capacity to run these workloads. It's not easy to run them in your backyard or so. You really need powerful computers to do these processing, and they have an unfair advantage here.
All right, Anurag, we can't get you on the horn without talking about Apple. And I know next week, June 10th, I believe, will be the developer conference for Apple. And that's an event every year where people like John Tucker and I, who don't know much about technology, we do pay attention, because that tends to be when Apple introduces some cool stuff. Maybe that it moves the stock of Apple, maybe it moves the stocks in other tech companies. Give us a preview of June 10th out in Cupertino, California.
Yeah, so I would say that these companies hold these events every year, but I would say for Apple, I don't think it has ever been so important than this year as to what big updates they're going to do to their software. Because right now, Apple's was caught off guard, like most of the companies did when ChatGPT came out and people figured out they are really behind the curve when it comes to AI adoption or their investments in this area. So Apple's been behind. There's no lying about it. But we are expected to see, you could say, an alliance between Apple and OpenAI. We don't know if they're going to do a similar deal with Google. That's pending. So there's going to be a lot of interesting stuff that shows up on Monday when Apple's going to showcase how this technology is going to get into your phone and make your life a little bit easier than what it is. And if that thing goes through, if it's executed well, then the shipment data or the unit sales data that we have seen for iPhones over the last 3 years, which has typically been flat. I mean, Apple's not seen any improvement there. I mean, you could see a lift over there.
Let me ask you about Microsoft real quickly. What's the deal that they struck with this AI startup? I think it's Inflection.
Yeah. So basically, they paid them a fee as a you could say compensation to hire a lot of their employees and make them part of Microsoft's internal AI division. And that's that's what it's been looked at, because as you know, larger companies cannot easily buy any companies at this point, or AI companies. So they are trying to see if they are you could say skirting the rules around acquisitions by doing this en masse hiring.
Folks, I think the real key advantages of Bloomberg Intelligence is that they have access to the best data for every industry that they cover. And in the technology space, one of those data providers that Bloomberg Intelligence has access to is IDC. That is the gold-plated provider of really independent data on tech spending, amongst other things. Anurag, I know you've worked a lot with the IDC folks. You use the IDC data a lot in your research. What are you getting? What are you sensing in terms of total tech spend? In terms of what's incremental for AI, and maybe what's just kind of taking from one tech, CapEx budget and putting it into AI? What do we know?
Yeah, so at least for this year, for 2024, it's more of a reallocation at this point. And you have to really think long and hard and say whether that's going to be the same case in 25 and 26. We think things are going to improve. Geopolitical conditions are not the best right now, so CIOs or CFOs are not that excited about ramping up their tech budgets. But we think tech as a percentage of global GDP is still a small portion. It's we talk about tech a lot, but it's not as big as, let's say, healthcare spending in the U.S., for example, when you compare both the numbers. So we really feel that there are enough you could say legs to this particular story out now. We think it's going to be in the form of more software spending over the next several years, then services spending. Hardware is doing well, so I think that may continue or that may not. It's a big question, but we think it's going to be incremental spend coming in the next few years.
The expectations are really high for technology. What if they don't meet the expectations? What's in the unexpected bin at this point and the potential downside?
Yeah, you see, you talked about 2 or 3 names, Nvidia, Apple, and Microsoft. But when you look at other companies, let's say if you were to pull a chart of Salesforce or Workday or Accenture or TCS, they've all been going down, or they have not seen the same benefit coming through. And that's where the allocation is being taken away from and going into the hardware areas. So those are the companies that could see slight improvement next year. The sentiment is really bad in the software arena right now because of the lack of that spending. I think that may change next year if economic conditions improve, or I would say geopolitical conditions improve.
All right, Anurag, thanks so much for joining us. Anurag Rana, he's a senior technology analyst for Bloomberg Intelligence, based in that burgeoning tech hub of Chicago, Illinois. We appreciate him checking in there. So even HPE, you think about HP, the old Hewlett-Packard Enterprises, they actually came out with numbers yesterday that were really strong, and they cited AI servers. So there's a company like Dell. You think Dell PCs, right? You think HP PCs, printers, stuff like that. But they're doing these servers that are being used by these AI folks, and boom, it's moving their numbers.
Are you saying all you have to do is attach AI to
I
something
think so.
and it's one of your products?
Well, one of the things I'm thinking about when you think about AI, what we have not had, like we had with Google and kind of the internet and all that kind of stuff, where's that big IPO company that is the AI IPO? Like Google was, how do I play the internet? Oh, you go buy this Google thing. Or you buy Yahoo back in the day. There isn't that IPO that's coming out and everybody says, oh, this is the AI play.
Well, I think startups and where the angel investors are putting money right now, who's out there you've never heard of?
Right. That's kind of where I'm looking to the Dan Ives of the world to say, hey, where's that next company that's going to come public that's going to be the AI play?
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio in New York City. We're streaming live on YouTube as well, so check us out there. And Bloomberg Podcast is how you search for us there. As Lisa was just reporting, Lululemon has what Bloomberg First Word is saying. Lululemon jumps on, quote, better than feared 1Q reports. I think the expectations are a little bit low there, but the stock's rallying about 2.5–3% here today. But the shares of Lululemon are down 38% year to date. So let's figure out what's going on there in Lululemon. Again, I'm a big fan, but it's interesting. The stock has really been under pressure. Poonam Goyal, she's a senior U.S. retail analyst for Bloomberg Intelligence. She joins us via Zoom from Princeton, New Jersey. Poonam, what did you see in Lululemon's earnings, and what does it tell you about maybe the retail consumer?
Sure. So I think the earnings are better than expected because while we do see slowing growth at Lululemon, where it's decelerating from the mid-teens to low double digits near 10%, there was concern that is that because of a slower macro and the fact that Lululemon is losing out to competition, Alo Yoga, etc. We discovered that part of that is true, but part of that is not true. And I think that's why investors have a little more confidence.
How big is the U.S. market for them, and are they selling overseas, and how much?
Yeah, so the US market, the Americas, is 80% of their business. International is 20%, with China half of that.
And is demand picking up or slowing in China, or is it new to the Lululemon market?
So international was a bright spot this quarter. International sales grew about 35%, and within that, China was up, mainland China was up 45%. So a lot of growth there. It's a bright spot for Lululemon. International is part of their three-pronged strategy to double sales into 2027. It's been doing very, very well, and we expect that to continue.
All right. So, and folks, if you want the best research on the street on Lululemon, just go to BI Go, and you can find Poonam's research there. And I'm looking at your research here, Poonam. You're talking about, when you talk about that doubling sales to $12.5 billion, by 2026, the company, and you're saying strong international growth. Okay, I get that. Men's growth? Talk to us about Lululemon and men's. I mean, it's just not. John and I don't know where to go with this.
Do real men go to Lululemon?
Exactly.
Poonam is what he's asking.
Real men are going to Lululemon. It's one of their bright spots right now, and they actually think that men's could become over time. I think it'll take some time, 50% of the business. So there's a lot of opportunity in men's. And, when you walk those stores and I looked at the men's inventory, it actually looks great. It's not just about outfitting the men to go to the gym. It's about outfitting the men to go into work with casual, comfortable wear that they can wear to work,
Oh, wait a
wear
second.
out.
Everybody who listens to this program and views this on YouTube knows Paul is the company fashion police.
Yes.
If you saw somebody in like Lululemon come into the office,
yeah, it
you'd
might
have
be
a fit.
problem. It might be a problem, but I'm going to defer to Poonam because she knows fashion here and she knows what works. So if I'm Lululemon, talk to us just about what they're saying about the consumer out there, Poonam.
So the consumer, we've been talking about this for a while now. The consumer is selective. They're choosing where to shop, when to shop, how to shop. And if they see the right product, they are still purchasing it. The one thing that struck out during the call was that traffic was up in the quarter, which means people are still going to Lululemon. They still have purchase intent. But there were some product missteps, which they're working to correct into the second half of the year, where they didn't have the right colors, or they didn't have enough colors, I should say. They didn't have enough depth and sizes. They were running out of the small sizes. So these are problems that I would think are execution related and are being fixed and can be fixed into the back half. So while there is still part of a macro problem, the story isn't that Lululemon people are not going to shop there. People still are interested in the apparel. They just have to fix the product a little and really improve execution into the back half.
They're known for form fitting, but just to get back to the men's fashion, do they have anything for old fat guys?
Well, their
Asking for a
ABC
friend.
men's franchise is really popular, and it's not form fitting. It's about the casual flair, and they have done very well there. And you don't need to wear tight leggings for men's. That's not the appeal there. That's
Oh,
for
boy,
the woman.
thank
But
you.
I'd say even for the woman, what worked really well in the quarter were their loose fitting pants and their biker shorts. So yes, leggings is a big business for them, but they are broadening that.
Hey, let's switch gears just a little bit. I saw it yesterday, reporting in the Wall Street Journal, Poonam. Dollar Tree is mulling the potential sale spinoff of Family Dollar. What is going on with the dollar stores here? I would have thought that if a part of the consumer market is weak and the lower end economically, that perhaps that would be good for the dollar stores. But what's going on there?
So they're really two very different types of dollar stores. Jen Bartashis covers the space, but from my coverage of it years ago, I can tell you that Dollar Tree targets everyone, right? I would shop at Dollar Tree, Paul. You would shop at Dollar Tree. You buy that 125 item there and you go treasure hunt. But a Family Dollar customer, that's their principal discount store. That is where they buy their groceries. That is where they buy their day-to-day needs. So as that customer's wallet is being stretched, that business does come into more pressure
I got to
generally.
tell you my Dollar Tree story.
Yeah.
I bought a loaf of bread. I brought it to the counter, and the cashier said, "Sir, you don't want that." Apparently, they had some sort of rat problem. I didn't know about it.
All right, Poonam, thank you so much for joining us there. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst, Bloomberg Intelligence. Give us a breakdown on Lululemon. Again, some better than feared results, and they actually lifted their guidance a little bit here. So some good news there for Lululemon. Stock's up about 2.5%, but it's down pretty big this year. Concerns about growth there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
If you look at the equal-weighted Standard & Poor's index, up about 5%. The question is kind of where do we go from here? We've got a Fed that appears at some point it's going to be cutting rates. You got that on one hand. The other hand, you got decent earnings growth. That kind of seems pretty constructive here in the marketplace. But let's check in with somebody who does this stuff for a living. Nicole Webb, she's the Senior Vice President. She's a financial advisor at Wealth Enhancement Group, joining us via that Zoom thing. So, Nicole, as you sit down and talk to your clients here today, they've had a pretty good start to the year by and large. What are you telling them about the back half of this year?
Yeah, I think the back half is a little bit to be determined, but in the interim, we expect it to be pretty choppy. And I say that, for a myriad of reasons. I think the first being there was so much expectation that entering this year, and your lead-in was so perfect, was that, we were going to see this broadening out in the market, a breadth that would come through the first 2 quarters of 2024. And that's not really been the case. And actually, over the last couple of weeks, which we've seen is less breadth and more leadership in mega technology again. And so, probably to get that next stickiness, the next run from here, one would expect that we need more confidence throughout the cap spectrum, not just concentrated in technology. And then you couple that with the fact that we've had a lot of interest rate volatility. I mean, really, even in the last 5, 6, 7 trading days, the 10-year has moved a lot. And so, there's some underpinnings to this market right now that we expect to, keep it choppy for the coming weeks ahead.
The data that we've been getting, does that show slowing that indicates an interest rate cut that's going to be good for equities? Or does it show slowing of the economy that's going to be bad for corporate profits?
Our stance on cuts is that, and it kind of circles back to the ECB today, which I loved that their words were a bit hawkish in tone, but their actions were that they want to see rates stabilize.
Yeah, the ECB cut, but at the same time, Lagarde also said there were inflation concerns, or she doesn't know how close they are to the neutral rate, or words to that effect.
Exactly. And so, I think as we keep seeing economic data that is in support of, many consumers that are slowing, but then many who are benefiting from the run in the markets, also clipping 5% coupons on risk-free assets, you kind of need to start hearing a tone from our Fed that we need to start the process of normalization of rates, because there are certain elements of the inflationary trends around us, some of these pockets of stickiness in service, the undersupply in housing, that simply probably can't be fixed by leaving rates as restrictive as they are. And so, I think it was a really balanced message from the ECB, and one that we would love to see, the Fed here take more of that stance on. You can remain hawkish in your tone, but you can start to move towards normalization and do it at a slow and steady pace versus continuing this narrative of going into a rate cutting cycle, which, sounds very different. It sounds like fixing a new problem.
So, Nicole, talk to us about valuation here. I'm looking at kind of S&P earnings growth, kind of 10, 11, maybe 12% over the, next year or so. Is that enough to support this valuation in the market, or do you feel like you need to maybe get a little defensive in valuation?
There's this convergence of themes. One of them being we went in to the year with earnings expectation, consensus among analysts Generally, you see analysts start to cut those earnings forecasts, which in the first month or two we did, and then we've seen a steady increase in those earnings expectations and where we think this market is going to take us. Again, though, I go back to the earlier comment, which is we need more than just the support of mega technology for that next leg or the next wave of this bull market, or to have more confidence in it. But at the same time, it's pretty clear that you need a lot of free cash flow, that there's going to be a huge CapEx expenditure over the next many years to build the new infrastructure, to build the AI factories, and that the megatech companies are the ones who have the cash flow and the access to do that. And so, aside from more government intervention or more fiscal money put at building out this infrastructure, we do believe that you're probably going to continue to see multiples that are substantiated by both the investment towards future growth, the breadth of that growth, and then, also though, when do you start to see some of those productivity, reshoring metrics for further success, again, down that cap spectrum within the S&P 500. And then as we think even further about the broadening out of the market, it really does seem like until the Fed starts to enter a normalization narrative around interest rates, that we're not going to get that further support from mid and small cap, which again is just been very volatile amongst the consumer data, the inflation data, and then again interest rate volatility.
Do you move beyond the big mega cap stocks and maybe into the derivatives of artificial intelligence? Do you have to be more strategic in that area?
Overall, we think it's really important to think about artificial intelligence, the build out of the infrastructure as being future table stakes among many companies. So if we think of the internet, at one point it was incredibly interesting, and now it's as if you would never run a business without it. And I know that is a little bit cliche and simplified, but I do think you have to look beyond just the productivity within each company and think more about end benefactors. So right now there's so much onus put on the suppliers. We've seen the pressure on software because there's a lot of curiosity about, is that more of a middleman that gets stripped out of this equation? But we think of, and so a very easy example would be, John Deere, things that become end benefactors in terms of access to robotic arms and the ability for artificial intelligence, instead of fertilizing entire fields.
It's the tractor that doesn't need a farmer.
It is the tractor that doesn't need a farmer. Thank you. You got there faster than I could. And so you have to think about what are businesses that are truly revolutionized and what businesses just become table stakes owners of, AI as part of its operating technology.
Nicole, I'm guessing you probably get some phone calls from your clients saying, hey, I could just buy a 2-year treasury and get close to 5% here. That's not a bad place to be. What do you tell them about fixed income these days?
Yeah, I never thought that I would spend so much of my time for consecutive years talking about treasuries. It is incredibly interesting. And,
yep.
I would say post the great financial crisis, we started to really change the way we ran financial models because we sat in a 0% interest rate environment for so long. And effectively, you had to think about how you then modeled total return as a component of that. And so now, if you were running projections at 5-6%, maybe 7%, but someone can clip 5.4 on the short end, it becomes really hard to get them to take equity premium risk over that risk-free rate. And so
yep.
It's really a combination of thinking about public markets, private markets, and then how much duration are you going to build into your portfolio today? How far out are you going to go? Because for many, the tax equivalent yield on a 10-year is still incredibly lucrative.
Yep.
And so, that is becoming a bigger part of the overall conversation.
All right, Nicole, thank you so much for joining us. As always, Nicole Webb, she's the Senior Vice President, Financial Advisor at Wealth Enhancement Group, joining us from New York via Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
For the month of June, Bloomberg Radio is committed to bringing you segments and guests focused on the topic of equality. Today, we're speaking with Norman Chen, CEO of the Asian American Foundation. He joins us via Zoom from San Francisco. Norman, thanks so much for joining us here. I'd love to just start at the really basics here. Tell us what you do at the Asian American Foundation. What's the focus, and how are you guys impacting this environment?
Well, first, thanks for having me. The Asian American Foundation is a 3-year-old organization that was formed at the peak of anti-Asian hate in 2021. We work together across the country, across all sectors, on safety, belonging, and prosperity for our community.
Does the China rhetoric, which in Washington has been focused on technology and trade, does something as subtle as that, does that conversation need to change, or at least acknowledge that it can result in, what you see in terms of hate speech and hate action against the AAPI community?
Yeah, language is really important. As we saw during COVID, rhetoric blaming China for COVID, Kung flu, Wuhan virus severely affected our community, leading to thousands and thousands of attacks that continue today. And while there are legitimate competitive issues with China that need to be addressed, inappropriate or inflammatory language does lead to perceptions and misperceptions of our community that continues to lead to feelings that Asian Americans are threats in this country, that we're more loyal to Asia than to the U.S., and other misunderstandings.
So practically speaking, Norman, thank you. Practically speaking, Norman, how do you guys go about trying to effect change? How do you do that?
Yeah, we have 4 pillars to achieve safety, belonging, and prosperity. Number 1 is to address the immediate hate and attacks against our community. And we work with a network of 56 national partners, or partners across the country and 14 cities that provide care to victims and survivors that have suffered these terrible attacks. So those partners are on the ground. They provide medical, financial, legal support to those who have been traumatized by these incidents. But longer term, we work in education and narrative change. So we promote the teaching of Asian American history in schools around the country. And now 7 states have mandated the teaching of Asian American history, because Asian American history is a critical part of American history. And then on our narrative change piece, we're working to tell more authentic stories about Asian Americans and less the stereotypical kinds of stories. One survey that we did asked people around the country, can you name a prominent or famous Asian American? And for most people in the country, they cannot. We're largely invisible to them. The number 1 name that has come up over the past 4 years, over 20,000 people, is Jackie Chen, who is actually not even Asian American. He's from Hong Kong. Wow. And then it's Bruce Lee. So you can see the impact that movies and TV shows have on the general psyche. And so it's really important to address that as well.
The Allen Mall shooting, that was, a little more than a year ago at this point, where a gunman targeted a Texas location because, presumably, at least we're told by authorities, because of its AAPI population. In Texas, can you tell us what the response has been?
Yeah, we have wonderful partners in Texas that are really advocating for the teaching of Asian American history. They're also fighting against land laws that prohibit Asian Americans from buying property in Texas. Wonderful partners. There's real activity in Texas. And we also work with corporate partners that are helping to promote Asian American programs in that state.
Yeah, you mentioned the property, but I believe there was also a bill in Georgia that I think had the backing of Governor Brian Kemp that would ban Asian foreign nationals, Chinese foreign nationals, from owning property in the state. Can you give us an update on that?
Yeah, there's legislation in multiple states around the country. Unfortunately, there's been fear-mongering, as you pointed to earlier, that people who are Chinese nationals shouldn't own property, and they're trying to focus it around certain, military or sensitive institutions. While there are legitimate national security issues that need to be addressed, this perception that Asian buyers, Chinese buyers are potentially a threat really affects the market, so that realtors in these markets now are afraid or hesitant to bring on Asian buyers. And so that really has a ripple effect to the broader community, this sense that somehow Asians are not loyal to America, that provide risk to America, and we're really trying to fight that.
Yeah, you sound like we can go back to World War II and
Sure.
Hawaii and internment of Asian Americans.
Yeah, exactly.
Yes, 120,000 Japanese Americans, 70% who are citizens, were incarcerated for 3 years because people thought that they were going to be disloyal. And it turns out there was no proof at all during that time that any of those people were any national security risk to the country.
It's an unfortunate, a long history of the United States.
Norman, talk to us about, is there a role for, corporations, businesses, and their leaders to kind of get involved here? What are we seeing?
Yeah. Oh, thanks for the question. So one very interesting fact about TAP is that we were formed by prominent Asian American business people, such as Joe Tsai, owner of the Brooklyn Nets, Joe Bay, co-CEO of KKR, Jerry Yang, co-founder of Yahoo. So we have very much a DNA with business background. And so one of the real strengths of TAF is that we are working across all sectors. So not just nonprofit or philanthropy, but also across the corporate sector, across government sector, and also with media and entertainment. And at our gatherings around the country, you have such a mix of people who all want to support our community, but come at it from different backgrounds. So our fourth pillar, which I didn't mention, is called representation and resources. And a lot of that is focused on our corporate partners. So what does that mean? We know from our status index research that Asian Americans are the least likely to feel like we truly belong in this country. And in fact, only 18% believe we truly belong and are accepted. Major reasons for that are discrimination, racism. Clearly, if someone spits at you or insults you, you don't feel very good. But also because we don't see enough of our people in senior positions. Asian Americans make up 15-30% of workforces, but only 3% of the C-suite, despite the model minority myth, which makes people believe that, Asian Americans are highly successful in business. It's not proportional across the organization. So we're working with our corporate partners to not only add and increase the presence of Asian Americans on boards at the C-suite level, even among ERGs, but also working with our corporates to funnel more resources to our community to make these changes.
Norman, thanks so much for joining us. Really appreciate getting some of your time. Norman Chen, he's the CEO of the Asian American Foundation, joining us via Zoom from San Francisco.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Tucker, he's sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming on YouTube, so you can head over to youtube.com and search Bloomberg Podcast. John, I don't know. I'm at the point in my life here. All the kids are out of the house. I'm eating out more in restaurants than I ever have, and maybe it's also post, COVID type of thing. I don't know. Restaurants, I think, are packed. I mean, I think the restaurant business is doing pretty good. I know there's different levels of it.
Well, the restaurants you're going to
Yeah.
are different than the restaurants like somebody like me and Charlie Pellet go to.
You think? I'm going to the Swan Tavern tonight. Pizza and beer night. That's what I'm doing tonight. But anyway, Barry Ritholtz, he's got a piece out on this whole restaurant thing. What does it mean as an economic indicator? So I wanted to touch base with Barry and see what he's doing there. Barry Ritholtz, host of Masters in Business on Bloomberg Radio. Fantastic podcast, folks. If you want a business podcast, markets, all that kind of stuff, he gets the greatest guest. It's called Masters in Business. He's also got a day job. He's a founder of Ritholtz Wealth Management. He joins us via Zoom. Barry, I know you've been known to go to a restaurant or two, maybe not the kind that John Tucker goes to, but
let's hope not.
How do you look at the restaurant business as just an indicator of the economy?
These issues, whenever you hear me complaining about some terrible bit of economic analysis or discussion, it's because some client said, hey, I know you've been constructive on stocks for the past 2 years, but look at this video a friend just sent me. The restaurant industry is collapsing. We have to get out of stocks. And, I go look at the video, and not only is it mostly incorrect, it violates every rule of statistical analysis. It's filled with bad information and denominator blindness. And so it sends me down the rabbit hole of hey, what's really happening in the world of restaurants? And as it turns out, the restaurant industry is on target. In 2024, it will be the U.S. restaurant industry's biggest year ever in sales, $1.1 trillion by the end of December. And that's based on the first half a year of actual sales and then estimates from the Restaurant Association, National Restaurant Association, for the rest of the year. Now, again, I'm a little skeptical when people are forecasting a 5.4% increase in revenue. Maybe inflation adjusted, some of that's right. But when they survey restaurant operators, about a third of them said they're expecting to see higher real sales for the full year. And 2/3 of them have said the restaurants in their area have rebounded from the pandemic fully. So, it's taken a while for this sector of the economy to recover. But man, you try and make reservations at a decent restaurant, you better be looking out 2 or 3 weeks or you're not going to get in.
It also depends on where you're located. Barry, I think you did an interview with Bobby Flay some years ago,
yes,
who was saying it's almost impossible for a restaurant owner, an individual, to turn a profit in a place like Manhattan because the rents are so high.
Right. Well, first of all, it's a very difficult business no matter where you are. It's razor thin profits. The Restaurant Industry Association says that 2/3 of restaurants will fail in the first 5 years. It is tough. A great restaurant is a really good business, but restaurants as an industry are incredibly competitive, incredibly difficult. Now, the interesting thing about the discussion with Bobby Flay, who I'm a giant fan of, my wife and I have his cookbooks.
And he's a nice guy.
Back when Miracle Grill was his first restaurant and I was living on 27th Street, we would go over there, and that was before Mesa and some of his other bigger restaurants. But given what's been taking place with work from home and how empty office spaces are, the proposal I've made is, hey, if you're an office building owner and you want to get more office space rented, well, then you better cut a deal with your ground floor tenants to make sure it's filled, because nothing reduces the value of an office floor than coming in and seeing a boarded up restaurant or a no retailer on the ground floor. I think retail as a service, restaurants as a service, is something that the major urban areas need to consider, because their bread is buttered, all pun intended, with the 20-year office leases that they're going to, sell tens of thousands of dollars worth over the next 20 years, tens of thousands of square foot. A restaurant that's down on the corner, a deli, a half-decent restaurant, even a high-end restaurant, they need to be a whole lot more flexible than they've been, and they really have to think about this in a very different way.
I saw the article in the Bloomberg yesterday. I've been waiting to read it, and it finally came out yesterday about San Francisco. How there are signs that San Francisco is bottoming and turning. For the first year, last year, they actually added people in San Francisco, 840 additional people but it was
well, you got to start somewhere.
You got to start somewhere.
Right.
I mean, Barry, what do you think about a market? I know you spent a lot of time in San Francisco, a lot of there's a lot of ingenuity there, a lot of money there. How do you think about a city like San Francisco, which, in my opinion, before the pandemic was a jewel of this country in terms of you got to go there? How do you think about
one
San
of the
Francisco?
most beautiful cities in the country, no doubt. Everybody wants that one answer, like a binary yes or no, and here's the solution. We have a lot of problems that are multi-factor. There are a lot of things driving it. When you look at a city like New York or San Francisco, NIMBY is a giant problem. All the rules that prevent additional building and construction, that's an ongoing issue. Like, there isn't a whole lot of things that can't be solved when prices are too high. The old joke is the cure for high prices is high prices. You either have to lower your prices or bring on more supply. We're starting to see that in suburbia. It hasn't quite happened in New York City or San Francisco, at least not rapidly. And I have vivid recollections of watching the entire lower Manhattan region following September 11th completely pivot from uptown, downtown to much more of a residential area. And I think that has to happen in more cities. Yes, I know a lot of these buildings don't lend themselves to fast and easy conversions. Let a few $500 million or $1 billion buildings go into receivership. You'll see how fast and easy they get converted. They'll get converted to residential. And I think we have to recognize what the pandemic taught us, which is we are no longer in a 9 to 5, Monday to Friday, 1950s Mad Men era of office work. That ship has sailed. There are some firms that insist on 5 days a week. For us, we give employees a whole lot more flexibility. We think that's a great recruiting and retention advantage over some larger firms. But it's pretty obvious the hybrid methodology is here to stay.
Yep.
And that means we have too much office space and too little residential in these urban centers.
Yep. All right. Great stuff as always, Barry. Appreciate your perspective. Barry Ritholtz, host of Masters in Business on Bloomberg Radio and also founder of Ritholtz Wealth Management.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.